Here to help us sort it all out, the investment pros. Danny Hughes, Divine Capital CEO, is back with us, looking fantastic in that red dress. Jim Frischling, president of NewOak Capital, he doesn't look too bad either. Hillary mix in the boring with the not so boring and then gives you an exciting portfolio. But I think one of the problems is too many people buy one stock at a time that Matt was talking about here. But this volatility, I think, is orchestrated. I think the big boys understand how the game is played. They look at inflows. They understand move a stock up. The crowd will see it. They'll get into it, somehow manipulate it. It's not hard to manipulate a stock down because selling begets selling. I feel like they do it on purpose, Jim.
Well, look, I'm not sure you said boring and looked at me, but I'll take it. No, I think you commented on 500 points really since 3 o'clock yesterday. Last night on the show, we talked about oil. We talked about the turning point. We talked about the Eurozone and some favorable news. And you guys, we actually said we thought there was more momentum to the upside and, would oil be challenged? And I think that's what we saw today. But
golly, a couple people were angry yesterday. We had the nerve to say that. I just hope they covered their shorts.
You look at Cliffs, and one of the reasons they actually did well today was I think they're taking some pain. I mean, they cut their dividend. They've made some acquisitions that haven't worked out. And I think the street was kind of rewarding them for kind of trying to rein in some of their debt. But that's why I'm in Danny's camp. But I think CapEx is going to have some limitations this year. Certain companies made big investments. They got to see how they play out. And I think other companies right now are still a little gun shy until other things are sorted and the volatility in the markets and certainly in oil, I think, is a headwind to CapEx spending.
Well, we had this conversation last night. We almost universally agreed on the show that we thought oil was bottoming or maybe hit a bottom. I got no less than half a dozen really angry emails or tweets from people who are in this industry saying you guys have no clue of the damage that's going on. It's going to get worse.
On the oil side, I think what you heard Phil talk about, and I agree with his points, he's really focused on the supply side. We talked on your show about Saudis winning this war against some of the marginal players here in the U.S., and they are. The fact is you've seen the production cuts, you've seen the rig cuts. So on the supply side, and I think that's why the bottom, calling the bottom is not too dangerous because we are pulling back on the supply side. Then there's the demand, which is where is the demand for oil going to help drive it further? So I do think we'll move higher because of these cuts, but I don't think we take off now because I don't think we've actually solved the demand side of the equation.
Well, let's say oil.
Chevron, Phil said it. Small players are going to be marginalized. The bigger players, big dividend, they'll take out.
I still like EOG, and I updated my pro guy had just lost a whole bunch of money on a failed project, and then he went on vacation and he took an old camera and he put a plastic bag around it. Next thing you know, he's a quadrillionaire. It might work this time.
Yeah, look, it's a no-frills app, so it's the cheapest entry to trade. But again, I was in the camp of you can actually try to learn how to do this and learn from it. I think there are better alternatives. I don't think they're trying to steal from you, but I do think they're trying to offer the cheapest way of actually getting access to the market, which is what they've done.
All right, Mary, I've even used Yelp, and I'm like an internet dinosaur, troglodyte.
Yeah, actually, of all the names, Yelp actually is one of the ones I'd be more concerned about because I think their first mover advantage is eroding very quickly. I think it's less reliable just because of how much junk and garbage can be put out there. Again, I did like it. I think it's losing its luster. But again, to Matt's point, people want to raise their stock price. How do you do it? You buy shares back. That's one way to do it. Another way, you got to find growth. If you can't do it organically, you're going to have to put some money to work and buy a company. We've been talking about a lot of potential acquisitions.
Well, Yahoo's sitting on a ton of money. People want them to buy something. Yep. IBM is sitting on a ton of money. People want them to buy something.
And they're making the right decision.
Can I start a rumor? Can I start
one? Yeah, of course.
All right, BlackBerry. I'm not starting it. People have been talking about it.
Right.
Not only am I a user, the new Classic, actually, for BlackBerry folks, I think it's a great device, but away from my like for it, the patents portfolio has a lot of value, and whether Samsung is denying it or not, the fact is I think there was a need for that type of patent portfolio and the need to kind of, Samsung's going to compete with Apple. Don't write that thing off yet.
We should say that Jim is basking in his glory because he told you a couple of days ago to get in Staples, so now he's kind of feeling it a little bit. All right.
I'll go quiet now.
All right, guys. What do you think?
One thing I noticed about auto sales, credit in the auto space is actually easy. Credit in the auto space is easy.
The guy from Weekend at Bernie's can get a car. I mean, you kidding me? You don't even need a pulse. You can get a car.
And again, when you think about, potentially, I don't want to say a bubble or anything, I will say, though, the availability of credit is helping to fuel consumers feeling better, and they can get funds.
Well, the average loan now is 67 months.
But, Jim, we're talking about the grumpy person that misery loves company. You know what I mean? Like, it's bad enough,
right.
Okay, you've got issues, but don't bring the whole thing down.
I think that's right. I mean, first of all, the cost of replacing people, the cost of, as people turn negative and people start moving on, it's 2x the cost of keeping somebody. So you want to keep your good employees happy. You want to keep them motivated. And a bad apple, as Danny said, can really poison the well. Hire slow, fire fast.
Shorts aren't dumb people. I mean, they're sort of, stubborn. They're single-minded. Shorts, they'll short a stock at 100 and stay short at 2. But they've been wrong on this one, Jim.
They've been wrong on this one. Look, I'm a customer. I'm a big fan, as you guys are, of the company. The 30 times PE, to a certain extent, it trades, as Matt said, it's performing. It's beating industry growth rates, but it is trading at a fairly full value. And I think that's why the shorts are bet against it. But this thing can continue to go, and I think it will.
Price for perfection. We have price for perfection. Chipotle, getting really crushed because they missed the whisper number. I haven't heard a whisper number in a long time.
Same sort of sales, not as robust as Wall Street wanted. But again, food costs going up, and heads up. We talk about labor, increase in labor. That would hurt Chipotle too. So price to perfection is
all right, guys. All right. Thanks a lot. Great show. Congratulations. You had a great pick with Raytheon. You had a great pick with Take-Two. You had a great pick with Staples.
I had BP.